After studying this module, we shall be able to know the significance of decision making and managerial decisions, learn the process and stages of decision making process, identify different types of managerial decisions, evaluate each decision vis-a-vis the suitability for the business, understand the position, role, and responsibility of a management accountant in an organization.
According to Peter F. Drucker, whatever a manager does, he does through decision making. In simple words, decision making is the process of choosing best course of action from amongst several alternatives available. Decision making is the only way by which managers at different levels in the organization perform their basic managerial functions of planning, organizing, staffing, coordinating, controlling, and decision making.
There are various kinds of decisions, such as 1. Programmed and non-programmed decisions, 2. Strategic and tactical decisions, 3. Individual and group decisions. These categories of decision making can be briefly explained as programmed and non-programmed decisions. Programmed decisions are routine and repetitive in nature, about which desired information is available, and therefore it neither passes through decision making process nor decision making stages. Strategic and tactical decisions. Strategic decisions are made by top level management. These are critical to the survival and success of the organization. Tactical decisions, which are also known as operational decisions, are made for the implementation and success of strategic decisions. Individual and group decisions. Individual decisions mean decisions made by an executive or board collectively. Group decisions are made by a team of consciously constituted group which is considered well equipped for taking a decision. Decision making process. Decision making process involves 7 steps. Number 1, identifying and defining the problem. Number 2, developing alternative solutions. Number 3, evaluating each alternative in terms of certainty conditions, risk conditions, and uncertainty conditions. Number 4, selecting the best alternative from amongst the several options available. Number 5, implementing the decision. 6, evaluation and control. 7, modification if any. Decision making stages include: number 1, preparation stage; number 2, incubation stage; number 3, illumination stage; number 4, elaboration stage; number 5, verification stage; number 6, implementation stage. Special type of costs for decision making are: number 1, product cost. It is the cost associated with manufacturing process. 2, period cost. These are costs required to manage, maintain, and develop business. 3, opportunity cost. This is the cost for foregoing an opportunity. 4, conversion cost. These are the costs of converting material into finished product. 5, committed cost. These are costs with respect to rent, rates, insurance, etc. 6, Controllable costs. These are within the control of management. 7. Uncontrollable costs. These costs are influenced by external forces and cannot be controlled by the management. 8. Shutdown costs. These costs are incurred even after the business is closed. 9. Sunk costs. Historical costs incurred in the past are known as sunk costs. 10. Urgent costs. These costs are to be incurred immediately. Managerial decisions involve alternative choices. In order to make such decisions, management requires data regarding relevant costs. The most versatile technique, namely marginal costing, is of immense help in decisions involving alternative choices. There are many situations with alternative choices.
Yet another managerial decision is the selection of desired product mix or sales mix. Contribution is an effective tool for the purpose of determining the most profitable product or sales mix. The best product or sales mix would be the one which will yield the maximum contribution. Sales or product mix is the proportion of different products and services that comprise the total sales of a company. In most cases, each product or service that a company provides has a different profit. So, changes in the sales mix, even if the sales level remain the same, usually result in differing amounts of profit from one period to the another. Thus, if company introduces a new product that has low profit and which it sells aggressively, it is quite possible that the profit will decline even as total sales increase. Conversely, if a company elects to drop a low profit product line, instead push sales of a higher profit product line, total profits can actually increase even as total sales decline.
There are two types of factors to be considered before making a decision, namely quantitative factors and qualitative factors. Quantitative factors include number 1, idle capacity and idle workers that can be utilized for production. 2. Marginal costs should be compared with the market price. Number 3. Loss of contribution to be considered when company is running at full capacity. Qualitative factors include number 1, quality of goods supplied by the vendor. Number 2, the facility of wider choice in case of buy decisions. Number 3, surplus labor force to be absorbed. 4, if secrecy, special quality is to be maintained, then even if the making cost is higher, the company would make rather than buy it. The next managerial decision is adding or discontinuing a product line or department. Invariably, large sized companies having multi products or departments come across situations where the management has to take decisions regarding adding a product or dropping a product line. The management must keep an eye on the warning signals which indicate that a product is in danger zone. Some of the warning signals are 1. Declining sales. 2. Increasing consumer complaints. 3. Increase in number of cases filed with the consumer redressal forums. 4. Decreasing market share. 5. Variable costs increasing revenue. 6. Need to lower product price constantly to maintain sales. 7. Return on investment much below expected minimum level. Before deciding to drop a product, factors other than contribution should be considered which are: number 1, competitors' position in the market; number 2, how prestige of the company would be affected on closure; number 3, in what way the suppliers would be affected and its impact on future relationship between suppliers and the company; number 4, fate of retrenched workers and company's liquidity position to pay off retrenchment compensation; number 5, whether company is working below normal capacity or full capacity; number 6, long term impact of the product to be dropped.
While assembling a product, management is quite often faced by a challenging question regarding whether to continue buying a component part or make it. We all know that sale is made up of three basic components, namely variable cost plus fixed cost plus profit, which means that profit of the seller is included in whatever the company is purchasing from the vendor of that component part. If the company makes it itself, then logically there would be a saving equal to that of profit, which was being paid to the vendor. But this is not true in all situations. The reason being that larger the production is, lower would be the cost. So, it may be more viable to purchase rather than make it in certain situations.
One of the best ways for a company to improve its profit in low growth market where increase in market share is difficult to obtain is to use its marketing and sales activities to alter the sales mix in favor of those products having the largest amount of profit associated with them. Sales managers have to be aware of sales mix when they devise commission plans for the sales staff, since the intent should be to incentivize the sales staff to sell high profit items. Otherwise, a poorly constructed commission plan could push the sales staff in the direction of selling the wrong products, which alter the sales mix and result in lower profits. A cost accounting variance called sales mix variance is used to measure the difference in unit volumes in the actual sales or product mix from the planned sales or product mix. This can be calculated on the basis of certain steps. Number 1, subtract budgeted unit volume from actual unit volume and multiply by the standard contribution margin. Number 2, do the same for each of the products sold. Number 3, aggregate this information to arrive at the sales mix variance for the company. The formula being actual unit sales minus budgeted unit sales multiplied by budgeted contribution margin.
When the business is faced with extreme situations such as acute competition or depression, the product may be priced below the total cost if such a decision is necessary. If variable cost technique is used when the price must be higher than the variable cost so that it makes a contribution towards fixed cost and help reduce loss to some extent. When price is just equal to variable cost, then loss will be just equal to fixed costs. Therefore, under these special circumstances, if selling price is higher than variable cost, the production should not be stopped.
This is because fixed costs will be incurred even if production is stopped. But in case production is continued, then at least fixed costs will be recovered to some extent and loss will be reduced. However, as a note of caution, Selling price below total cost should be decided for a short-term basis, as no business can afford to incur loss on a long-term basis. For the survival of any business, the price must be fixed, which is above total cost. Selling price to be below variable cost under special circumstances. Under this situation, obviously, the loss would be much more than the fixed costs. Here, it would be better to stop the production so that loss becomes equal to fixed costs. However, the management on many occasions takes the decision to continue production even when the selling price is below marginal cost. Some such circumstances are: 1. For popularizing a new product; 2. For eliminating competition; 3. For disposing of perishable products; 4. For keeping plant and machinery in operation; 5. For sale of conjoint products, which is making larger profits; 6. For maintaining production and keeping employees occupied. Operate or shut down decision. In the short run, if a business is operating at a loss, where the revenue is less than the total cost, or the price is less than the unit cost, then it must decide to operate or temporarily shut down. The shutdown rule states that in the short run, a business should continue to operate if price exceeds average variable cost. When a business decides to shut down, it must compare the total revenue to the total variable cost. If the revenue which the firm is making is greater than the variable cost, then the business is covering its variable costs and there is an additional revenue to partly or entirely cover the fixed costs. On the other hand, if the variable cost is greater than the revenue being made, then the firm is not even covering production costs and it should be shut down immediately. Implications of a shutdown. The decision to shut down production is usually temporary. It does not automatically mean that a business is going out of business. If the market conditions improve due to price increasing or production costs falling, then the business can resume production. Shutdowns are short run decisions. When a business shuts down, it still retains capital assets but cannot leave the industry or avoid paying its fixed costs. A business cannot incur losses indefinitely, which impacts long run decisions. When a shutdown lasts for an extended period of time, a firm has to decide whether to continue the business or leave the industry. The decision to exit is made over a period of time. Replace or retain decision. These decisions are usually related to plant and machinery. There are two types of situations faced by management in this respect, such as whether to continue operation with the existing plant or replace it with a new one. If replacement decision is taken, then there is a decision relating to replacement alternatives available. Let us now discuss the method of selection. The first step is to compare the operating cost of existing plant with that of the one which can alternatively be purchased. A comparative statement of both options relating to profitability, return on capital employed, and interest on capital be made. The second step is to calculate opportunity cost involved. And finally, assess the effect of disposal of existing plant. buy, or lease decision. The business is faced by a variety of situations where decision making is not all that simple. Manufacturing businesses face the dilemma of choosing between whether to buy a plant or machine or take it on lease, as there are different types of benefits attached to each option. Steps involved in evaluating the lease or purchase decisions are: 1. Determine the after tax cash flow for each year under lease alternatives by using the formula lease payment amount minus tax benefit on lease payment multiplied by tax rate into lease payment amount. 2. Determine the net present value of after tax cash outflow using after tax cost of capital. Then determine present value of cash flows associated with the leasing alternative. 3. Determine the after tax cash outflows under buying alternative based on borrowing, which is present value of purchase price minus present value of tax benefits of depreciation provided. That is, present value of cash flow associated with the buying alternative will be ascertained. 4. The decision between buying or selling will be made by comparing the net present value under each of the alternatives. The alternative having lower net present value will be preferred. Principal and interest payments, when discounted at the appropriate borrowing rate, will always be equal to the amount borrowed. Therefore, there is no need to consider the principal and interest repayments. Profit planning decision. A company usually carries on business for the whole year, and only at the end of the year profit is computed. Under profit planning, this order is reversed. Under profit planning, start is made from the end result. Profit planning can be described as a plan for the future operations to attain the maximum profit or to maintain a specified or desired level of profit. In this exercise, sale, cost, and production alternatives are all received in harmony with each other to determine how they will yield the desired profit figure. Marginal costing technique helps in profit planning as it is based on behavioral study of cost.
Let us now summarize what we have discussed in this module. Decision making is critical to any business. Decisions taken in business can be programmed, non programmed, group, individual decisions, strategic and tactical decisions. Managerial decision making has several dimensions with alternative choices. Managerial decisions regarding make or buy the product from market would depend upon both quantitative and qualitative factors. While adding or dropping a product, management should pay heed to the various warning signals and must consider factors other than contribution. While analyzing a product or a sales mix, the mix that yields most profit must be selected. Operate or shut down decisions are taken for short run. In order to avoid losses, if situations favor, the company can restart business again. Replace, retain, and buy or lease decisions are taken with respect to plant and machinery. Under these, post-tax outflows are calculated for assessment. Management accountant plays a pivotal role in organization. He is part of the top level management team and helps management in taking all key decisions.
Management accountants work for public companies, private businesses, and government agencies. They may also be called cost accountants, managerial accountants, industrial accountants, private accountants, or corporate accountants. But all perform similar functions within a company. Indeed, preparing data for use within a company is one of the features that distinguishes a management accountant's job from other types of accounting jobs, such as public accounting. Management accountants are risk managers, budgeters, planners, strategists, and decision makers. They do the work that helps the company's owners, managers, or board of directors make decisions. A management accountant will analyze basic data and make forecasts, budgets, performance measurements, and plans, and then present them to senior management to assist them in operational decision making. A management accountant may also identify trends and opportunities for improvement, analyze and manage risk, arrange the funding and financing of operations, and monitor and enforce compliance. They might also create and maintain a company's financial system and supervise its bookkeepers and data processors. Further, management accountants may have an area of expertise such as taxes or budgeting. Management accountants' role and responsibilities. Management accountant performs variety of functions and several vital responsibilities. Some of these are: he helps in maintenance of accounting records and preparation of financial statements. He helps in making budgets. Management accountant provides help in designing of an accounting information system. Management accountant ensures that the accounting information system is adequate and useful in accordance with budgets, plans, policies, and decision requirements. He coordinates budget making and report preparing activity. He also prepares performance reports, control reports, special managerial reports for planning, control, and decision making. His prime responsibility is to lend support to the top level management. He has responsibility of providing and interpreting accounting information. He has to ensure that the information system meets varying needs of different personnel. Finally, he helps in taking all non-programmed decisions. Management accountant needs a solid foundation in hard accounting skills, including knowledge of basic accounting, generally accepted accounting principles, and basic tax principles. Since management accountants function inside a business, he needs a good grounding in economics and soft skills such as communication and presentation skills, writing, persuasion, and interpersonal skills.
Management accountant holds the highest position in the organization. Usually, he is given the designation of controller of accounts. Because of the vital functions performed and role played by a management accountant, he is often recognized as a member of the top management team. He helps the management in making policies and taking critical and significant decisions. Thus, a management accountant is not only a service arm to the management, but also he is part of the management.